My talk is entitled Recovering from a Credit Crisis, and I've been so fortunate to serve on the Portland branch of the Federal Reserve. Each month, we gather in Portland, the board members, along with an economist that is sent up from San Francisco, and we have very robust discussion about the international, the domestic, and the local economy. In fact, each month, the chairman sends us, Chairman Bernanke, 2 questions that are very, very important and pertinent to understand what's going on currently. For the remaining of this talk, I'm going to share with you some of the economic predictions as well as the feedback that I have gotten from surveys of those 2 questions from local executives. This recession has been very different. It was led by a credit crisis of epic proportions. As banks wrote off billions in losses, lending came to a standstill. Companies and individuals hoarded cash, in effect self-funding their cash needs. Corporations cut expenses and laid off employees. Consumers stopped spending, and the economy was thrown into a very deep recession. Recessions that are credit crisis driven are, in fact, very difficult. As this chart shows you, in the gray band is what the norm has been for economic recovery for recessions from 1953 through the current recession. And what it plots is looking at the time the recession begins, each quarter, what the GDP recovery path looks like. In gray is basically the band of what the recovery path has been for all the recessions, as I said, going back to 1953, up until this current recession. And you can see here that the 2007 recession is not only deeper, but also is anticipated to take a lot longer to recover from. So the Federal Reserve, in all times, has 2 mandates. The first mandate is stable prices, aka low inflation levels. And you can see here in this graph, going from 2000 to 2010, that the Fed has been very successful in keeping inflation at a very moderate level, running around 2% a year. And in fact, the Fed is anticipating that going forward for the next 2 years, the inflation rate is actually going to be lower and maybe running around, Chairman Bernanke, if you listen to his comments, maybe running around a low level of, say, 1% annually. So with the Fed's first mandate under control, they had additional information that they got from executives. And let me share with you what the local executives here have said about prices and cost expectations going forward. Here are the 2 questions that we received in August of 2010. They are, to what degree are your company and industry facing downward or upward pricing pressures? And looking ahead over the next several months, do you expect prices in your business and industry to fall, stay flat, or increase? The local leaders responded here, 73% were facing moderate to heavy downward pressure on their product prices. And the factor these executives reported that were contributing to continued downward pressure in their prices included pressure from competitors and weakened demand. 33% expected prices to fall over the next several months due to excess capacity. 50% expected prices to remain flat, and only 17% expected to be able to raise prices. The Fed's second mandate here is full employment, aka keeping the unemployment rate low. As you can see in this graph, charting from 2000 to 2010, in black is the unemployment level. And it spiked dramatically up to just over 10%. Unfortunately, today, it remains very stubbornly set at around 9.5%. In June of 2010, Chairman Bernanke sent us the following 2 questions. For your business or businesses with which you are familiar, what is the outlook for hiring over the next several months? And are any particular factors restraining hiring? The answers from local executives, the majority of the company executives interviewed did not expect hiring activity to pick up. 44% reported plans to hold their workforce at current levels. 31% reported plans to lay off additional workers, and 25% reported plans to begin hiring employees, but mostly as a replacement to jobs already lost. The factors these executives reported that were restraining hiring, including a desire to preserve productivity improvements, continued sluggish demand, and fears about inflation and concerns about a double-dip recession. So the Fed has been trying to understand why the unemployment rate seemingly is stuck at 9.5%. And one of the theories is that there's this mismatch between the jobs that are available and the skills that workers have today such that they remain unfulfilled. So Chairman Bernanke had these questions in June of 2010. Has your business or others with which you are familiar experienced significant difficulties finding qualified applicants for existing job openings? Is the degree of mismatch between job requirements and applicant skills greater than it was before the recession? The local executives reported 46% did not perceive a problem due to mismatch between required qualifications of the job. And the other 53%, some of those reported some job skills, specialized skills mismatch. But other reasons were competition for higher skilled laborers from competitors, which was keeping them from being successful in filling their job openings, as well as unreasonable salary expectations given the tough economic environment. And more significantly, all of the local executives did not perceive a mismatch between job requirements and applicant skills greater than before the recession. A bright spot in the economy are businesses. And these two charts look at the financial health of corporations, the largest corporations in this country. On the left, the chart is looking at the pattern of GDP, which you can see declined somewhat. However, corporate profits fell dramatically through this recession. The good news is that corporate profits have actually recovered and are higher than before the recession began. This particular graph looks at cash assets as a percent of total assets for corporations looking back to 1960 through 2010. And what you can see is that early on in that 1960 time frame, corporations held about 6% of the assets they had on their balance sheet in cash. It had declined significantly, reaching around 2.5% to 3% in the decades of the 80s and the 90s. And most recently, it has climbed back to 6%. In fact, today, there is around 8% of cash on corporate balance sheets. So corporations are healthy and strong, and they're poised, this is large corporations, they're poised to be a driver of economic recovery. Questions that came to us in August from Chairman Bernanke had to do then with capital spending behaviors. The first question is, what are the plans both for IT and overall capital spending over the next 6 to 12 months? Obviously, this would be a significant generator of expanding economic activity. And have these plans for IT or overall capital spending changed recently? The answers that we got at a local level on capital spending, 57% were planning on IT-related capital expenditures. 29% were foregoing capital expenditures to strengthen their balance sheet, though, to conserve even more cash. Small businesses remain today uncertain about the future. And this particular chart was a survey that was done of small businesses, same questions that go back to 1990 through 2010. Here you can see in purple that for small business owners, the number one problem is regulatory and tax uncertainty. The study shows here, the recent one in 2010, that 35% of those executives surveyed considered taxes and government requirements as being their number one problem. We had 2 questions this month from Chairman Bernanke on fiscal and regulatory uncertainty. They were, are there specific fiscal or regulatory issues for which uncertainty has increased recently? And if you have perceived increased fiscal or regulatory uncertainty of late, do you expect it to diminish significantly in the months ahead? The answers from local executives, nearly a unanimous opinion that uncertainty regarding the fiscal and regulatory environment is restraining business investment, hiring, and consumer spending. The two areas of greatest concern were taxes and healthcare, and the tax issues evolved around business taxes, especially the expiring Bush tax credits, income taxes in the state of Washington and the possibility we may have a state income tax, and estate taxes and the impact on small family business. And interestingly enough, the executives did not expect the current climate of fiscal and regulatory uncertainty to abate. So, where are we today? Well, the recovery is continuing, but there are some headwinds, including high unemployment, low consumer confidence, and really low confidence and expectations for small businesses in the country. The good news is that the leading economic indicators, shown here in red, which are tracked from the summer of 2007 to current, are not indicating that we are likely to face a double-dip recession. So, large corporations are healthy, and we really need to focus on a few things. Quantitative easing is something that the Fed is considering. You're probably hearing about it in the news. And I'm sure all of you are aware, particularly those that are depositors at banks, that the Fed really can't push down short-term interest rates much farther. They are extremely low. So the only other alternative for the Fed from an easing standpoint and additional monetary stimulus is to continue to purchase long-term agencies like collateralized mortgage obligations, as well as long-term treasuries. This particular chart is looking from June of 2008, before the recession hit, to June of 2010. And notice here that in blue, treasury securities make up between 500 and about 600 billion of the Fed's balance sheet. Starting in the recessionary time, they made a very strong move to start buying federal agency securities, and the federal agency securities combined with treasury securities today is about a $2 trillion investment by the Fed. They have been successful with this strategy of buying treasury securities and federal agency securities in holding the 30-year mortgage rate, as you can see here in red, and the 10-year treasury rate relatively low. But the main dilemma, and one of the reasons why you're hearing there's such debate, is because they're funding these purchases of long-term assets with borrowings from banks. Today, the banks actually are loaning money to the Fed at about 0.25% of interest. And the Fed is turning around and buying treasury securities and federal agencies at around a 4% return. So they're making a really good margin today. But going forward, they're going to hold those assets on their balance sheet. And as interest rates go up, the borrowings that they're receiving from the banks could become more costly. And in fact, it could turn to a negative spread. That would mean that they would have to ask the Treasury to fund money back to the Fed, which could be a very politically dicey situation. So, just to conclude, the recession officially ended in June of 2009. The leading economic indicators do not indicate a double-dip recession. A stronger manufacturing base is developing, as well as improved balance sheets and financial conditions for the largest corporations. Consumer confidence has stabilized, but unemployment needs to be pushed lower before consumer spending will increase. And long-term and short-term interest rates continue to be accommodative to stimulate the economy and GDP growth.